Okay, good afternoon, everyone, and welcome to another session that we are hosting here in conjunction with the Nasdaq exchange on identifying trading opportunities in today's market. Not only are we going to take a look at the broader equity markets, we're also going to take a look at volatility. We're going to look at interest rates and see how they factor into our views for the longer term directional view here of the broader markets. There's a lot that we want to cover here today, and I do think today is a great time to cover the markets because I do think we are at a pretty pivotal turning point in equities, potentially lower. And I want to show you what I would use from an options trading perspective to take that directional view and how you can reduce your exposure using options when you're taking a directional view, such as what we are doing here in the markets today. And I'll also show you a little bit about if you disagree with our views and you want to take an opposite view, what type of structures you can use, how to position or how to manage those particular trades, and some of the differences between trading ETF versus index options and what potential benefits you may be able to get from looking at the different types of structures or the different products that you have access to in today's market. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that you're going to see here during today's session. So what you're going to spend some time learning from me today is first, we're going to take a look at the general market outlook. Like I said, we're going to take a look at equities on the daily and weekly time frame. We're going to look at volatility. We're going to look at interest rates. This is going to largely help us understand from a timing perspective and from a directional perspective, what's our view and what is our conviction, if you will, on that view. Then I'm going to take a little bit of time and really talk about the difference between index and ETF options. Many of you currently trade ETF options. Today, hopefully, I'll also show you a little bit about index options and what's different about them, what benefits you might potentially get. And then we'll talk about the strategies for this current market. I'm going to use both bullish and bearish examples, but I'm going to show you my directional view and what type of structure and what type of strategies I would use in this current market environment. Then we'll take a look at trade management and kind of the rules around managing these trades, and also talk about position sizing and scaling, very important element of trading. And lastly, I'll open this up for Q&A here at the very end. Now, before we embark on taking a look at the market outlook and giving you a sense for what my views are, I do want to launch a poll here. I want to ask the audience, where do you see equity markets in 1 week's time? Higher, lower, or you're not sure? Okay, so at this point, you have answered, so a good chunk of you have answered. 50% of you say lower, 20% of you say higher, and 30% say I don't know. So quite a large number of you, not an extreme level. Actually, less than half of you believe that markets are going to move lower. A pretty significant chunk of you are quite, I would say, not confused, but indecisive, meaning you don't know. You're kind of in this halfway point, right? You've seen the markets show a bit of strength here over the past few weeks. They certainly haven't moved any lower, but we haven't really seen it push past the recent resistance level that would certainly suggest that bulls are back in control. So I think that this is quite, or rather the data is not particularly surprising. And the fact that only 20 of you see that the markets are higher means that at the moment, certainly skew is towards to the bearish side. But from my perspective, what's interesting is that it's not extreme, right? It's not like 75% of you believe that markets are going to move lower here next week. Usually when we see that type of extreme, that's usually a good sign that perhaps things are about to turn the other way around. But because only half of you believe that markets are going to move lower, we're not an extreme reading here. So it could really go in both directions here, in my opinion. So 20% of you say higher, 50% of you say lower, and a solid 30% of you say you don't know. Okay, great. Now let's take a look at the markets and let's look at the views, right? But the primary thing that I want you to walk away from today's session is a clear understanding as to what opportunities and strategies can be utilized in this type of volatile market that we're currently in, or choppy market rather, where kind of you just bounce back and forth. You don't really have a good, clear sense of direction. And I think that's why 30% of you answered, I don't know. How do you make sense of all of it? Well, today we're going to take a look at some of the charts that help make inform my decisions of the broader market. So the first one I want to point you to is a Nasdaq-100 NDX index. We all generally know the Nasdaq-100 index. It is 100 of the largest non-financial stocks listed on the Nasdaq-100. We know that back in November, the Nasdaq-100 broke this long-time trend line that has been in place since the beginning of the pandemic. This happened here in November. Things quickly turned south here. It traded all the way down to the bottom of the, it first bounced off the top of the cloud up to the base and conversion line, then broke down to the bottom of the cloud model again, back to the top of the cloud, and then eventually broke the cloud. And pretty much since we broke the cloud, the equity markets have been on this downtrend. But over the past few weeks, we started to see some stabilization, right? Higher highs, higher lows at the very least. And the question was whether or not we were going to see this push higher back towards this base conversion line. Right now, we're trading just around 1,200. The baseline is trading just north of 13,000. So we're going from 12,000 to 13,000. This was the potential opportunity going into this week. Now, from my perspective, everything else on the cloud chart looks bearish. You have a bearish cloud here. We're trading below the baseline. We were trading below the conversion line, and the lagging line was below the cloud. So everything here was pointing to bearish. But we did have what looked like a break above the conversion line, and there was the opportunity for a quick short rally to that baseline, which again, like I said, was just shy of 13,200 on the NDX. So that gave us some hopes, and I think some bulls jumped in here over the past few weeks hoping that was going to happen. But as of right now, granted, we still have 4 days left for this weekly candle, and a lot can happen in the next 4 days, especially with the big earnings week coming up. And I haven't looked at earnings that report after today's close just yet, and you have a few big names here. But as of today's close, we were back below the conversion line. So this is leading me to believe that there is further downside, especially if you look at the names here. If you look at the daily charts here of Apple, of Amazon, of Alphabet, you know, the big names, Tesla, the big names in the Nasdaq-100 index, you know, they're all trading up against some serious resistance levels, and they were actually all rejected here today. And I'll take a look at a few of them here at some live charts. So when I look at this on balance, my view here is that we could see some further downside here from an equities perspective. Now, this is based on the weekly cloud model. Let's take a look at a few other charts before we make a decision. The next chart I want to take a look at is the VolQ index. This is the Nasdaq-100 Volatility Index. Many of you are familiar with the VIX index, which is the S&P 500 Volatility Index. This is the VolQ, which is the same index for the Nasdaq-100. And what we see here is pretty much since November, we've had a series of higher lows. And just recently, we tested the bottom of the cloud model. And again, this is really an opportunity for volatility to expand here again. Now, that is a bearish side here for equities. That volatility has been relatively low, and there's an opportunity here for volatility to expand. So that's another thing that I'm currently paying attention to, is that this could be potentially a buying opportunity from a vol perspective, especially here to the downside. So a directional view, so far, everything looks quite bearish here on the Nasdaq-100. But like I said, we still have 4 days left for that weekly candle to close back above that conversion line. And if we do see that close above that conversion line, we could see that rally up to that 13,200 level. So we'll know in the next 4 days or so. And then when we look at the NASDAQ relative to the S&P, this was one that I gave an update on last time we did this exercise. This is actually a 10-year chart. So this is a long-term chart. And what we see is that the NASDAQ-100 since 2013 has continued to outperform the S&P 500. Now, this outperformance did accelerate, if you will, meaning for a long time, it was a small amount of outperformance, but it kind of stayed within this particular channel until really the pandemic is when we saw the NASDAQ have underperformance, but it came back to a level that has held so far quite a few different times. So from my perspective right now, our expectation is still that in this type of volatile market, especially on bounces and on declines, that we can continue to see the Nasdaq-100 outperform the S&P 500. So as you're looking for potentially long opportunities in this market, and remember, this is a 10-year chart. This is not a short-term chart. The other charts we're looking at are a bit more short-term. What I'm looking at is kind of looking out a few weeks out, maybe a couple of months out. It's really difficult to look at beyond this current earnings cycle at the moment from my perspective. We're really focused on how do earnings come out this particular earnings cycle. Banks came out last week. The numbers weren't particularly good, but the market certainly reacted quite positively to them at the end of last week. We'll see if that continues this week as some of the other financial names report. And then we'll have a lot more clarity, in my opinion, towards the end of this week, especially as we start to get into more of the tech names next week.
Hey, I hope that you're enjoying the session so far. I would love for you to join me on my next live event, where you can learn alongside thousands of traders, and I'll answer your questions live. Either click on the link on your screen or check out the description below. I host weekly trading and education sessions just like this one, and you'll get to trade alongside our research team's daily trading signals, weekly technical research, and access the most intuitive option strategies analytics platform free for 30 days. We're here to help you succeed, and please make sure you like this video and hit the subscribe button. Thank you, and let's get back to it.
The next chart I want to take a look at here is a daily chart of the Nasdaq-100. So before we're looking at the weekly chart, now we're taking a look at the daily chart. The daily chart, as you can see here, we're currently trading just into that cloud model. So this certainly is more of a bearish tone. Now, from my perspective, the downside here is relatively limited. We're looking at about 11,000 on the NDX. Currently, we're trading at just shy of 12,000. So this certainly points to a bit of a short-term downtrend unless we break through the cloud. If we break through the cloud, like I said, we're heading back towards around 13,000 or so to the upside. So there is some potential bullishness starting to come into the market. But from my perspective, if you look at things on balance, things still weigh more so here to the downside. The last chart I want to take a look at, which factors into my decision-making process, is 10-year yields. This is, again, a weekly chart of 10-year yields. And what we have seen is a bit of a stall lately in 10-year yields. We've seen the Fed fight inflation. We've seen some of the economics numbers come out, and we saw a bit of wavering last week. There was some towards the beginning of the week. The probability of having a 100 basis point hike at the next meeting was pretty certain. And then towards the end of the week, that backed off, and we're looking at another 75 basis point hike. So interest rates have certainly moderated a little bit in terms of 10-year yields. And the fact that now we're trading below that conversion line leads me to believe that at the very least, we're going to see 10-year yields pull back to about 2.6, so 2.6% or so. If it gets back below 2.6%, then we can head a significantly lower. But I do think fundamentally speaking, we've got some support here around 2.6, especially as we look at the Fed and kind of what they're up against. Likely they're going to have to keep their foot on the gas pedal with respect to raising interest rates. And that's always going to put a bit of a floor here as to how much further 10-year yields can fall. But, we are having kind of a recessionary environment starting to play into the price of bonds, the price of equities in terms of where bond prices are going to be, what expectations are on earnings in terms of growth for the S&P 500 and the Nasdaq-100. These are all macro things that we have to pay attention to. But the one thing that I always do is I turn to the charts, because the charts incorporate, or rather the price that's on the charts incorporates all available information that's out there. And what we're seeing is all market participants ingesting that information and effectively agreeing on a price. And I'm using that price to help inform my trading decisions. So looking at the current market, while I do see that lower interest rates is going to be supportive of equities, I do think that the pullback here that we expect to see here in yields are likely going to be somewhat moderate and won't contribute, in my opinion, to a massive rally here in equities. Perhaps provide a little bit of a cushion on the downside move, but at the moment, a big thing that's driving kind of the markets are the earnings cycle that we are currently about to embark on this week and next week, where we have a massive amount of S&P 500s reporting in the next 2 weeks or so. So that's kind of my view here on the broader markets. We're going to talk a little bit about how I would structure trades along this particular environment. But before we jump into that, I want to talk a little bit about index versus stock or ETF options. Now, how many of you are familiar with trading stock or ETF options? Please type yes into the chat window if you are familiar with trading stock or ETF options. So trading options on SPY, on QQQ, on Apple, on Tesla. If you're familiar with it, type yes into the chat window. I'm not seeing any chats, which is odd. Normally I see a lot of chats. It's disabled. Okay, we'll have to take a look at that. I'm not sure why it is disabled. It should not be disabled, but okay. Sorry, we will figure out how to make chat enabled. That usually doesn't happen. But looks like most of you answered that in the Q&A section. Okay, sorry about that. We will look into that and get that fixed. So many of you have traded stock or ETF options. Now, what I want to talk a little bit about is how index options and stock or ETF options are different and similar at the same time. Because for those of you that have traded SPY or QQQ ETF options, index options are really quite similar in nature from the perspective of you're getting effectively direct exposure to the same underlying. SPY and QQQ give you access to a specific index through an ETF vehicle. Now, an index option gives you access to the index directly itself. And for the most part, these options work the same way as an equity or ETF option. But there is one very, very important and difference between ETF and index options that I think benefits the vast majority of traders that trade ETF options. And that's the fact that they're European and cash settled. What I mean by this is that, we know for a fact that more than 70% of options are closed before expiration, which means that the vast majority of you that are trading stock or ETF options never want to touch these ETFs or stocks, meaning you don't want physical delivery and you don't want the obligation of potentially having to take delivery or having to short sell that specific stock or ETF. So index options give you the exact same exposure as a stock or ETF option, but because it's cash settled and because it's European style, you have no assignment risk and you have no exercise risk. So whatever your P&L is, even if you held it through expiration, doesn't matter whether you're in the money or out of the money, it is all going to be cash settled at expiration. You will never have to either take delivery or be put the specific stock or ETF at expiration. Does that make sense, everyone? Please type 1 into the Q&A section if that makes sense to you, and I will look into how to get the chat re-enabled for everyone, okay? So just like most stocks or ETFs, ETF options, one contract controls 100 shares. Most indices has an index level that you multiply by 100 in order to trade the index option. So many times, from a trading perspective, the two are identical. They give you the exact same exposure to effectively the same underlying, but there are some very big practical differences. The European cash settle is certainly one. The other one is actually a tax advantage. And this is important if you're trading in a taxable account, at least here in the US, which is the fact that if you are trading QQQ ETFs versus, let's say, an XND contract, and I'll talk to you about what that means here in a second, the XND contract, the index option side, has a 1256 contract, which means that 60% of your gains are taxed at long-term capital gains and only 40% is taxed at short-term. And most traders trade options that expire in less than a year. So you're not holding on to trades for more than a year in most cases. So you have a tax advantage when you're trading the index option. Now, there are some advantages, I would say, in my opinion, to ETF options, which really is around the number of ETFs that have options listed on that. And this number has grown even more now. We're seeing more and more ETFs have options listed on them, and you can find ETFs just about for anything under the sun. So you do typically have access to more ETFs than you do direct indices. But those are some primary differences between the two. And the biggest one, remember, cash settlement versus physical delivery. You know, a lot of credit spread sellers, they don't like to ever be assigned, so they do certain things to avoid assignment, like cutting losses, taking profits, and managing these trades before expiration. Even when you're trading a long call or a debit spread, you have to think about them around expiration to avoid being assigned or being exercised on something. When you're trading that index option, you don't have to worry about that. It certainly makes managing these trades a little easier, and also potentially reducing a little bit on the transaction costs from not having to have it closing a trade and paying that transaction cost on that closing transaction. So talking a little bit about the Nasdaq-100 index complex. So this is really where you have a pretty wide variety of choice when it comes to trading these types of markets. And the Nasdaq-100, you have the full value index that's trading somewhere around $12,000 today. You have the full index, which is a 100 multiplier, right? So at 12,000, that's a $1.2 million contract. That is largely an institutional product. I do see some retail traders trading kind of really far out on the money credit spreads in these, but for the most part, a $1.2 million contract is an institutional Now, there's also NQX, which is the same Nasdaq 100 index divided by 5. So that when you multiply 100 on this, you get a $200,000 contract, which is sort of in between, right? You certainly have some larger retail clients which have no problem trading a $200,000 contract. You know, that's like Amazon pre-split. That's like Alphabet pre-split. You know, $2,000 stock, if you will, multiplied by 100. You know, large retail traders can trade this. But the Nasdaq realized that most traders having a $200,000 index was still out of reach for most people. And that's why they created XND. XND is the same product as the Nasdaq 100, but it is 1/100th the value. So instead of $12,500, it is now $125. So you multiply that by 100, and what you get is a $12,000 contract. So think about stocks that trade 100, 120 bucks. That's really where you're going to be able to use this as a index for more retail focused trading. So you can trade in much smaller size. And this is even better than the Qs, right? Because when the Qs are trading at 305, multiply that by 100, that's a $30,000 contract. Here, you have a $12,000 contract. And what it gives you is even more flexibility than the Qs, because a lot of people, when they couldn't trade these two products, they were jumping to the Qs. That was the only thing that gave you similar risk profile or similar exposure for a much smaller size. And now that XND is available, you can now trade XND for even more flexibility now that you have a contract size. It's roughly 1/3 of the size of QQQ. So you just have a little bit more flexibility and all of the advantages that you used to have trading NDX and NQX, just that perhaps you didn't have the portfolio size to trade those products in the past. And the other thing to remember is that these smaller retail focused index option products, so, you know, and there are plenty of micro listed index options these days, almost all of them are PM settled. What that means is that they align with what you're used to as stock or ETF investors, which are expirations monthlies on third Fridays, and they expire all on the Friday after the close, meaning they are settled based on the 4 p.m. Friday price to determine whether you're exercised or assigned. If you trade the full products, they have a combination of AM and PM settlement. If you look at VIX index options, they are all AM settled, right? So this just adds a little bit of confusion because the last trade happens on Thursday night, but it doesn't settle until the first print on Friday morning. So if you hold one of these things to expiration, you actually have overnight risk. So you're exposed to what happens overnight, yet it stops trading on Thursday night. So you can't do anything after the close. Not, again, suitable, in my opinion, for most retail traders. That's really an institutional product. So for the most part, from a retail perspective, you're really focused on these two products, XND and NQX. And I would focus more of my attention here on XND because this is truly the product that I think is sized specifically for retail. Okay, so what I want to do today is really take some examples and show you, based on my views on the Nasdaq-100 and what my views are here for the broader equity markets, how I would structure some trades, specifically options trades, to take my bearish view in the market and express it, but do it in a way with limited risk. But before I jump into those specific examples, I want to talk a little bit about option strategies for this type of volatile market, what type of strategies you might want to take a look at. Number one, in this type of more volatile environment, you might want to trade shorter dated options. And what this reduces is the time horizon of your overall trade. So you're trying to maybe look at where you think equities are going to be a week or two rather than a month or two. So selling those shorter dated options can potentially allow you to just take a shorter view and take it week by week because things are changing a lot week by week. You might get information this week that drastically changes your views on the overall market, and you want to be nimble and being able to adapt with it. When you trade shorter dated options, that allow you to do that. Index options allow you to eliminate exercise and assignment risk, especially when you're trading shorter dated options. You're going to come across expiration much more frequently, and you have to manage around expirations. Well, with index options, you don't have to manage them as frequently, or rather as much, because if you want to hold these to expiration, you absolutely can. Whatever your profit and loss at expiration, it just gets settled in cash in your portfolio. You can trade spreads, and we're going to go through quite a few examples of trading spreads, but they're going to help you offset the cost of buying options and reduce your risk for selling options. We're going to talk about both types of strategies today, and also we're going to talk a little bit about scaling in and out of your trades instead of being all in or all out of the broader markets. So when you have a view, don't just necessarily jump all the way in and go all short or all long, depending on your views. Especially when you're looking at over the next few weeks, you might want to start building your position on Monday. And if you are right on Tuesday, adding a little bit more, and then kind of scaling your way into that position rather than taking a full position on Monday and being fully committed to that by that whole week, because things are evolving quite quickly. So as I was telling you before, based on the chart work that I was looking at on the Nasdaq-100, from my perspective, I certainly think that things look a little bit more here skewed to the bearish side, especially since today we couldn't manage to hold and close above that conversion line. Also, the daily chart does not look strong here at all. Certainly favors from a risk reward perspective more here to the downside. Now, the one thing I like about taking a bearish position in this current environment is that the markets do not have to move much further to the upside before I can say I'm wrong, get out at a relatively small loss, and potentially flip my view back into that bullish view. Because like I said, the upside here is it's not a huge amount, but it's not nothing for it to rally back up to $13,000, right? So by the end of the week, we close above that conversion line. From my perspective, I would start to flip my view here to be a bit more bullish. But the market doesn't have to move very far in order for me to change my view. I would take a relatively small loss and be able to be nimble and kind of adapt as the market changes. But from my perspective right now, things still look a bit more bearish. And that's why I, at least myself, have started to establish some short positions here at the beginning of today. Some small ones, trying to see how this week plays out. And we'll see whether or not we'll be able to see that move here to the downside. And it looks like we have managed to get the chat back up and running. Thank you so much, Philip. So again, sorry about everyone for the chat being disabled here before, but looks like we are back here. So the first thing I want to take a look at is selling a credit spread. This is a simple very popular strategy, especially for this type of market environment. You know, we've been trading up towards this 120 level here that it hasn't managed to pass forward. So from my perspective, very easy to just to scalp for a move here to the downside. And what we can do, what we can do is, sorry, I don't know why I got all out of order here. I didn't mean to use the credit spread first. I wanted to look at the debit spread first. Because what I wanted to do is I wanted to take a view here in the broader markets and do so in a way with a relatively small amount of risk. And this is looking out a little bit further, but this is looking at that weekly chart, looking at kind of what the earnings that are coming up, and potentially saying that there could be some further downside here, especially if earnings start to come in. And if you look at the Nasdaq-100 big names, Apple, Tesla, Amazon, and Alphabet, these are big names that haven't reported yet, that have some significant potential downside. These are stocks that have largely been able to stay away from the 70, 80% declines that many of the names in the Nasdaq-100 have seen, specifically the high beta, non-profitable stocks. Are these big name mega cap stocks immune from that type of decline? I certainly think you're not going to 70, 80% decline in Apple, but you could see some further downside. And I think that is the risk that I see here for these names. They may not come in that 70, 80%, but I still think they could see that 40, potentially even 50% correction as we kind of price in more of a recession for these types of names. And for that, I want to look at both a hedging and more of a tactical play, if you agree with me, by looking at buying a debit spread. And I'm going out 60 days because generally speaking, when we look at debit spreads, we like to go a little further in time. That reduces our time decay per day, but I'm still going to use a spread here. I'm looking at buying the 120, 110 put spread here, paying $3.32 for a $10 wide debit spread. This has a max loss of $332 and a max gain of $668. So about a 2-to-1 risk to reward ratio. This is betting that we're going to get back down to the bottom end of that trading range around 110 or so. I do think that this could break down even further. If we do see that, I'll likely roll these strikes down as they start to move down towards that lower strike and keep moving my strikes down. But right now, taking a look at a short-term or relatively long-term for some short-term traders, but looking at that, 60-day window and encompassing the full earnings cycle to say that by the end of this earnings cycle, we could see equity markets lower. And I'd like to get paid a 2-to-1 risk to reward ratio for that and paying $332. And just to put that into context, $332 on a $119 an $11,900 contract is roughly 2.7%. I'm paying 2.7% of the index value to take a bearish view here over the next 60 days. And if I'm right, I get paid double that amount on that move. And if I am right, I'm able to roll my strikes down and potentially take further exposure if it does break that 110 level. And I do think that if we get back down to that 110 level, it's very easy for us to see a potential breakdown below that level and continue moving lower, especially if it's earnings that pushes us towards that lower level here at the current moment. So that's kind of my view here on how to take advantage of either a bit of a hedge on an long equity portfolio that you have, or if you're simply taking a bit more of a tactical play, if you will, a bearish tactical play. And that's kind of how I'm seeing this. I've certainly reduced a lot of my long exposure in my portfolio. I have some, but mostly, this is more of a tactical play. And then what I want to take a look at here are some credit spreads, right? So a lot of you are like to sell credit spreads. This is one way that you can also finance the purchase of a debit spread. Because if you sell the August 5th 119.5, 125, that's basically selling the 50 delta call option, the 119.5, and then buying a 25 delta call option, the 125 strike, you're going to collect $2.18 on this roughly $5 credit spread. Whoops. So a little bit under, just around 40% of the vertical width. And that risks $332 for every $218 you can potentially make. That's a little bit better than 1.5 to 1 risk to reward ratio. This is only 18 days to expiration. This is a very short-term trade. This is, again, a very quick scalp. And this will allow you to collect $218. Remember, buying the debit spread costs $332. This is going to collect $218. So for those of you that are a bit more advanced and like to trade this, you can potentially sell some credit spreads, collect the premium, and use that premium to buy that debit spread, so that, you know, if the index just stays where it is, the debit spread will lose some value, but whatever you lose on the debit spread, you're going to gain back on the credit spread. So you can split your position half and half to the credit spread, half to the debit spread. And if the markets do move lower, you're effectively getting the cost of that debit spread for a very small fraction of what you would have paid if you just paid the debit spread outright. So that's one way that you can also scale into this position here as well. So hopefully I'm giving you some ideas here as to how you can take the view that I might have and structure it in a way where, you know, you're not all in, you don't have all of your risk in one specific strategy, and you can spread your risk around here, but take a more of a core bearish view here and reduce the amount of premium that you pay, but get some convexity so that the markets do move south in a fairly quick fashion, that you're able to participate that if you simply just sold a credit spread, you're not going to be able to do. And I know many of you like to sell credit spreads on indices, and I know that that's a very popular strategy, and I encourage you to continue to explore that. But think about how you can capture some of that downside if you were to, instead of risk all of your money on a credit spread, maybe risk half of it on a credit spread and half of it on a debit spread, and see what the outcome looks like. Because I think that in this type of market environment, in this type of volatility, you could see some benefits from splitting up and using a bit of both in this market. And lastly, what I want to leave you with is, if for any reason you disagree with me, and many of you do, 20% of you said that you think equity markets will be higher here in a week. And I certainly think that can be made a case for markets moving higher. And just looking at how markets reacted to relatively negative news at the end of last week made me question a little bit as far as whether or not my bearish views were correct. I will say that I'm standing by my view that markets are likely going to head lower, but ultimately we can all be wrong. And what you need to plan for is, if things turn around, how do you play that? And one way that I would certainly take a look at is by selling a bullish credit spread. So same thing, going out to August 5th, which is roughly 18 days from expiration, that's going to cover the bulk of some of the big names that are reporting here in the S&P 500, in the S&P 500 and the Nasdaq-100, which is going to be in the next 2 weeks or so. And what I'm doing is I'm doing a similar type structure, but on the bullish side. I'm selling the 50 delta put, 119 put, and I'm buying the 25 delta put, which is a 113.5 put. Here I'm collecting $1.87 and risking $3.63. That's about a 2-to-1 risk to reward ratio. So not as strong as a risk reward ratio on the bullish side than it is on the bearish side, but that's just what credit spreads currently are paying in terms of a bullish credit spread here on the Nasdaq-100. And for all three trades, if you want to follow me, you can use this link here on your screen, and I'll copy this link and paste it into the chat window for those of you who want to explore these strategies a little further. So the first link I'm sending you is the debit spread. The second link I'm sending you is the bearish credit spread. So these are the two that I'm kind of splitting my trades in between. Instead of having all of my risk in one trade, I'm splitting the risk in half for each one. And that's one of the things that having a smaller contract size allows me to do. If I was trading a single QQQ contract, each is going to risk triple the amount that I would be able to do here on XND. And because I'm using the index option, I can split my risk in half, do half of it on a credit spread, half of it on a debit spread. And the last one I'll leave you with is the bullish credit spread. If you are in a contrarian view, you just simply want to disagree and you have a different view, we respect that. And that's part of what the OptionsPlay platform allows you to do, is quickly select a directional view and be able to look at strategies specifically for that directional view. Whether you want to take a look at a debit or credit spread, our platform does both instantaneously for you based on any symbol and the directional view that you put into OptionsPlay. So with that, what I want to talk a little bit about is managing these credit spreads. Because credit spreads require far more active management once you're entered these trades, I do want to talk through kind of how this changes when you're trading an index option versus QQQ, an ETF option. Because when you sell a credit spread on an ETF option such as QQQ, you have assignment risk and you have exercise risk. So if it lands, depending on where it lands, you can either be assigned on the short leg or you can find yourself assigned on the short leg and not exercise on the long leg. There's a lot of risk in that, right? And sometimes you can even be assigned early. So these are all things that you have to manage, and we have a bunch of rules in place to help reduce the risk of that. The 3 rules that we have is exit at a profit of 50% of max gain, exit at a stop loss of 100% of max gains, and then exit the trade at 21 days to expiration. But if you're trading these on index options, 2 of these rules are optional: the take profit rule and the 21-day rule. The take profit rule is optional simply because if the trade is profitable, you can just simply let it expire and hopefully let it expire worthless. You don't have to manage them. With the profitable credit spread on an ETF option, even though it's profitable, you still want to manage them because a profitable trade can turn back against you, and you just don't want to take on that risk. So, but with a cash settled index option, you don't have to worry about that. So the take profit part is optional. Let it run to potentially expiration and take 100% of the max gain. The 21-day rule is also optional because that rule was designed to help you avoid early assignment. And because you can't be assigned early on an index option, that rule goes out. So really the only thing you have to monitor for is the stop loss. And the reason that this rule is not optional, because that's just best practice of managing losses. If a trade's not going in your favor, don't let it keep going to, a max loss, right? Once you lose 100% of the max gain, get out. The trade's clearly not working in your favor. You get out, save whatever premium you can left from it, and apply it to the next trade. There's no need for you to continue to hold on to that and potentially lose even more. So the rule of thumb here is that if you've sold a credit spread for $1.50, the only rule that you really have to monitor for is the take profit rule. So if you sold something for $1.50, the stop loss rule. If you sold something for $1.50 and it's now trading at $3, you've lost 100% of your max gain. Because if you sold something for $1.50, the most you can gain is $1.50. So once you lose $1.50 of the $1.50 that you sold, and it's now trading at $3, it's time to cut your losses and move on. Because if you keep holding on to it, you can lose that other $1.50, and you don't want to do that. So this is really designed to help you avoid that loss, okay? So those are the rules for managing an index option. They become a lot easier. And the last thing I want to talk to you about, arguably more critical than anything else that I'm here to talk about here today, which is position sizing. I've been a market strategist for 16 years, and I cannot express to you how important position sizing and risk management is to the success of your trading. Arguably more important than your strategy, more important than the indicators that you use, more important than whoever you follow in the markets that help you navigate and understand the markets. You could follow the best trader in the world, but if you're not sizing your positions appropriately, I can almost guarantee that at some point you will come across a string of blows up your account. And I know many of you watching here today can relate to that, where you think you've got a great strategy, maybe you're following someone else that you know is successful at trading, but for some reason, at some point, you blow a hole in your portfolio because there's a string of losses that come in and you've lost 20, 30, sometimes 50% of your portfolio. If you can relate to that, please type 1 into the chat window. And the only reason I know this for a fact is because I've worked with thousands of you over the years. And the one consistent thing that I see is not, traders that can't find the right strategy or can't find, someone who can teach them, someone who's profitable themselves that is teaching you. That's never the problem. The problem is investors' inability to stick to a specific position sizing that's appropriate. And this has nothing to do with your skill level of trading. This is pure probability and math. Because if you exceed more than 2% of your total account per trade, your likelihood of blowing up a sizable portion of your portfolio at some point in the next year or two is roughly 50-50. And if you have a 50-50 chance of blowing a large hole in your portfolio, guess what? At some point, it's going to happen. And when it happens, you will find yourself discouraged. You will find yourself feeling that you're not on the right strategy, that you don't know what you're doing. And sometimes I see traders quit. I see some traders will say, I'm following the right person, and try to find someone else to follow. And next thing they know, they follow someone else and the same thing happens. And they go through this vicious cycle of going from one trader to the next, hoping that somehow the next trader is going to be the holy grail. But that never happens. And there's a reason that never happens, is because it's not your strategy that's broken, it's your position sizing. And this is something that I cannot express to you how important this is for your trading. And, as much as I can sit here and preach this, ultimately, it's your application of it that makes the difference. So what we created in OptionsPlay is a portfolio contract calculator. It's now in your profile as income settings and portfolio risk settings, where you can set how much you're willing to risk of your total account value. And what we default this is to 2%. You can change it, but I don't recommend you to do that. All you should do with this calculator is input your total account value, whether you have a $10,000 account or a $10 million account. Enter that amount. And our platform will automatically, on the risk and investment calculator, which is on your OptionsPlay platform, it will automatically fill out the amount that's appropriate for you to risk. So if you have a $100,000 portfolio, 2% of that is $2,000. And what you can do using our portfolio tool is every single time you place a trade, you click on the calculate button, and it will calculate the number of contracts that you can trade on that specific name or that specific option strategy and stay in your lane, okay? And even if you are staking within that $2,000 range, you might find yourself sometimes not only sticking to that rule, but also scaling in and out, meaning not every single trade you have to commit $2,000 in capital to. Sometimes you just say that, I'm going to put on half a position today. And that's what I did today with my bearish trades, right? It's early in the week. I want to see how earnings season plays out, but I wanted to get in early because I saw the opportunity this morning. I wanted to establish a short position because there was a good chance that markets were going to sell off today, like we did see here today. Not a big sell-off, but some of a sell-off here from the open. So I entered half a position. I wanted to see if the markets continue moving in the direction I expect to. I can always add to it, but I didn't want to commit full capital at the very beginning and potentially be out by the afternoon. So these are the tools that we have in place here to hopefully help you better understand how to think differently so that you have a better chance of succeeding. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And please type yes if you have used the position calculator in your portfolio. You can go to the risk and investment calculator, and there is a button here at the bottom that says adjust your defaults in your portfolio. I see a lot of yeses. And for those of you that are saying that you've never used it, go into your profile, set your settings right now, and make sure that you click on that calculate button and help you stay in your lane, and that's going to help you prevent account blowups. Now, in itself, that's not going to fully stop you from account blowups, because what you could do after with that position is totally up to you. I've seen people stick to this rule, and then once they have a losing position, they keep adding to their losing position. There are other things to discuss, but this is a really good first starting point to prevent you from even getting to a point where any trade blows up huge in your portfolio. I cannot tell you enough how many times I get comments or feedback back saying, your trade absolutely sucks. I lost a ton of money on that last trade. Well, the problem isn't the strategy. The problem is how much capital you committed to a single trade. No single trade should ever account for a large percentage of your portfolio. If it does, then you're doing something wrong. And I can almost guarantee that at some point, you're going to blow up your portfolio. So if you want to prevent it, stay in your lane. And hopefully our tools on OptionsPlay are designed to hopefully help prevent you from doing that. Now, before I open this up for Q&A, I do want to point you to where you can learn more about the index options that I spoke about here today. Many of you follow the Nasdaq-100 index. Now you can trade it using XND in a retail size product. And you can find out more about that at trade.optionsplay.com/XND. And you can sign up for OptionsPlay as a free trial if you have not already done so at optionsplay.com, which I will post a link here into the chat window. The platform is fully available to anyone who wants to use it on a free basis trial. This has the XND index already built into it, and you can choose from bullish strategies and see, bullish strategies, bearish strategies. That's how I selected my put vertical here, my debit spread, and you can look at automated credit spreads by clicking on the high implied volatility strategy. So all of these are fully automated for you when you type in XND, and you can even use the Ichimoku cloud if you like, using XND here with our charting package. I was looking at the daily chart. I was also looking at the weekly chart. Both, in my opinion, right now, look a little bit to the bearish side. As I was showing you here before, XND closing just shy of that that conversion line. So from my perspective, still looking quite bearish here at the moment for XND. So with that, what I'll do is I'll open this up for Q&A, and I will try to answer as many questions as I have time for before I have to sign off. And like I said, we have both the chat window and the Q&A window back up now, but please type your questions in the Q&A window, and I'll try to answer as many questions as I have time for here today. How to decide a credit spread based on stock price? So I don't use stock price or percentages to determine the width of a credit spread. I use deltas. The width between the strike that I sell and the strike that I buy is usually about a 25 delta. That's how I choose the width of my credit spreads. It's really based on a probability-based approach, based on the volatility of the stock, rather than a percentage, because 5% for Apple is very different from 5% on a higher beta name like Snowflake. So you can't just use percentages. You have to adjust based on volatility, and delta is the only metric that allows you to instantly adjust widths based on volatility. William, yes, those are all cash settled indices. I don't know of any index options that are not cash settled. So all index options, as far as I know, are cash settled. Maybe there's one or two that are kind of obscure that are not widely traded, but the widely traded ones are all cash settled. David, honestly, XND and XSP are the two that I know of, and XSP is a significantly larger contract than XND. So, I mean, we obviously know the S&P and the Nasdaq-100 has a very high correlation. XND currently trading about $118 gives you that flexibility of an $11,000, $12,000 contract. XSP is almost 3 times that size. We do send XND spreads on a weekly basis. So every single Wednesday, we are sending alerts on XND and kind of our directional view. So if you are a subscriber here to OptionsPlay, you do get a weekly commentary from me and my team on the Nasdaq-100 index and a specific trade structure on XND. What trading platform can we use for these indices? So Don, pretty much all of the major brokers support them. TD Ameritrade, Schwab, Fidelity, pretty much all of the major brokerage firms that you can trade index options support these. I think probably, Robinhood and some of the quote unquote millennial brokerage firms currently don't support them, but most of or all of the major brokerage firms do support them. The position sizing is coming to the Canadian platform. It is not there today. You have to do it manually, meaning if, let's say, you have a $100,000 portfolio and you want to risk 2% of it, you just have to enter the $2,000 part manually. The tools are there. You just have to enter $2,000 manually each time. We are implementing the new portfolio sizing to the Canadian platform, so you will have both soon. Where are the Greeks located in OptionsPlay? Great question. So there's a few places. The most important part, in my opinion, is when you click on Modify and you look at the strike dropdown, you have the Greek delta on the right-hand side. Because delta is used very heavily in helping me select my strike prices, it is on the strike dropdown. You have the strike price, the premium, and the deltas. Now, if you are looking for the more Greeks on the whole platform, then you have strategy in Greeks, which you have delta, theta, gamma, and vega. And not only do we express it to you in dollar terms, we also try to explain it to you in plain English. So it's a little easier to understand. My broker bank in Canada does not allow to trade debit spread or credit spreads. So for those of you that are in Canada that find yourself at a bank that doesn't allow multi-leg execution, I suggest that you take a look at Interactive Brokers or Questrade. Both of those allow multi-leg debit or credit spreads on stocks, ETF, and indices. And recently, TD Canada also released that as well. So you have 3 major brokers in Canada, in my opinion, that do multi-leg execution on US and Canadian stocks. How would you manage a credit spread if you're entering a weekly expiry position? So Kevin, if you're talking about an ETF or index option, one, I wouldn't do it. One, you're not collecting enough premium. You have a ton of gamma risk when you're selling a 1-week credit spread. That's just not something I would do. I like to go at least about 3 weeks out selling a credit spread because I'm trying to reduce as much gamma risk as possible. And that's really what you have acceleration of in that last week or so. So from my perspective, that's why I don't sell credit spreads that expire in 1 week. So David's asking a great question about open interest. And this is something that I see a lot of, at least retail investors that have a misunderstanding of open interest. There's a lot of concern that if something has low open interest and there's not a lot of people on the other side, that's kind of a false understanding of how options market work, because the underlying is the Nasdaq-100 index, which is one of the most liquid products in the world. It doesn't matter that open interest is 0. The market makers on the other side aren't hedging it with other contracts. They're hedging it with Nasdaq-100 futures. They're potentially hedging with QQQ stock, and these trade billions of dollars of turnover. So these are some of the most liquid products in the world, regardless of bid-ask spreads and regardless of volume and open interest. There's tons of liquidity. Put your orders in at the midpoint or just a couple of pennies off the midpoint. You'll find that you'll be able to fill. You'll be able to get filled on this quite easily. I saw a comment here before, someone who said that they've been trading this for I thought someone said that they had been recently trading this for months. Here, someone saying, I traded XND for several months. Getting filled is not an issue. So there is volume. That's what he said. I've been trading these myself. A lot of people say I use open interest on cover calls important for liquidity. Michael, I can't express to you how not important open interest is on, for example, a single strike. That's just not how market makers work. It's not like if there's no open interest, then I won't be able to get out because there's no one on the other side. That's not how market making works, because even if there's 0 contracts out there, the market maker just has to either go long or short the stock in order to hedge their risk. Even if there's no open interest, they don't have to offset your risk with someone else who's willing to be on the other side. Market makers are hedging their risk once they've sold the call to you by buying stock. That's it. Their risk is off their books, if you will, to some degree. So don't worry about open interest when you're looking at liquidity. You could look at open interest at the full chain. If you add up all of the open interest, that will typically also give you a good sense for liquidity. But with something like an index option on the Nasdaq-100 index, the amount of trading that's done on Nasdaq futures and QQQ counts into the billions of dollars a day. So which is why I think as a retail trader, when you're trying to do 10 lot, 20 lot, even 100 lot, you're not going to have execution liquidity problems. I hope that gives, for some of you, some concerns about liquidity, a good understanding as to how it actually works in the back end. And I actually have a whole video on this. If you want to look up how market making works on my YouTube channel on OptionsPlay, there is a whole video that I have done to give you and demystify how this works if you want to find out more. What delta should we use for debit spreads? So generally speaking, for debit spreads, we'll buy a slightly in the money option. So about a 50 to 60 delta on the long leg. And then we sell roughly about a 20 delta or about a 15 delta. So we usually sell about 1 standard deviation away on the short leg. Does XND fall in the pattern day trading rule? Unfortunately, yes. So these are ultimately equity options. So these are still subject to the pattern day trading rules. They're not a futures contract. Jeff, about the Ichimoku cloud, we also have a video on our YouTube channel on OptionsPlay on the Ichimoku cloud itself. So if you want to find out more about that, I highly encourage you to watch that video. We really go into the details of the 4 primary, important indicators of the Ichimoku cloud. I will say that, if you're starting with a $5,000 account, 2% is quite tough. You're going to probably have to expand that rule a little bit in the beginning until you grow your account. I do have a video on how to grow your small account. Also, if you want to find that on YouTube, it gives you some of the tools on how to start small and how to look for opportunities for small accounts using the credit spread report that we have, something that's a very popular tool that we have. So if you have a small account, take a look at that. Perhaps you might want to start there before you graduate to trading something like XND, which is still a $12,000 contract. There are plenty of trades that are $3,000, $4,000 per contract that might be more suitable for a smaller account. How do you add studies to the current chart? You click on this studies button here, or when you expand the chart, you'll see the studies drop down. But there's a studies button here on your screen next to the expand button. So Melanie, I do have a video on kind of getting started with options where we talk about entering orders, specifically for entering and closing orders. But I do find that your broker tends to be able to help you out the most because it is somewhat broker specific as to order entry. So that's something that you should think about. Have you spoken to Tom Sosnoff about Tasty starting these to trade? So you can trade XND on Tasty. You absolutely can. I have traded XND on Tasty. I've noticed very little open interest on XND volume, on XND options. So these are new products. That's part of why I'm here to talk about them because, new products need exposure and especially products that I believe in. That's why I'm here to talk to you about it. So new products have low volume. The more people that trade, the more volume that's going to come in. But that does not mean that low volume means that there's not enough liquidity. Like I said, the underlying instrument is the Nasdaq-100, trades billions of dollars of notional contracts per day. Market makers have no problems executing these orders, being on the other side and providing liquidity. They can provide, in theory, hundreds of thousands of contracts of liquidity a day with no problem because they would hedge it the same way they would on a QQQ option. So from my perspective, liquidity is not a problem, even if open interest and volume is on the lower end right now as things get started. From my perspective, I almost don't look at the bid-ask spreads anymore these days because market makers, especially with 16 going on 17 different exchanges with nearly 1.2 million options that a market maker is making a market in. Imagine this. Imagine you are a market maker and you are making a market on 1 million different option series. That's what they're doing. Think about every single strike. They're posting a bid-ask quote on 1 million different strikes across 17 different exchanges. That is computationally one of the most intense jobs in the world. And I honestly think that these guys are absolutely insane to be in this type of market. But in order to protect themselves, because you can't really monitor risk in a true way across 1 million series on 17 different exchanges, they simply widen their quotes out so that they're taking on relatively small risks, right? So that if something comes into the market that moves the market and they're not reacting fast enough, they have a ton of exposure out there, right? So the way that they reduce their exposure is by posting really wide bid-ask quotes so that even if something moves, they're still within that wide bid-ask quote and they're not taking on true exposure. So this is one of the more unfortunate, I would say, mechanisms of having so many options exchanges and having listings on all these different strikes. Think about how many strikes there are available on SPY. We have dailies now from going from $50 to like $500 on SPY. Do we need all of those strikes? Probably not. But as a market maker, I have to make a market in all of those products. And if something comes out that I'm not someone fires a missile in somewhere else and the markets move very quickly, I'm not able to react fast enough across all million series that I'm making a market on, I'm going to get screwed. So how do I prevent myself from getting screwed? Is I widen those quotes. But if someone comes in and places a limit order in between those quotes, I know that there's another customer on the other side, especially a retail customer. I'm going to interact with that quote and fill you, because even the bid-ask quotes don't really reflect what my views are on the market. It just reflects my ability to take risk when I'm making a market on 1.2 million series across 17 exchanges. It's absolutely insane the amount of work market makers need to do to provide you, streaming quotes across all of these option series. So wide bid-ask quotes, in my opinion, mean absolutely nothing. It is just the unfortunate nature of the market structure we have in the options market. We're the only options market in the world that has this many options exchanges, and we're the only options market in the world that has 1.2 million listed options in the US alone. So making a market is an unfortunately computationally impossible task, that the only way to prevent themselves from taking on too much risk with something unforeseen is by posting wide bid-ask quotes. So that doesn't mean that you shouldn't interact in the middle of those quotes, because when you interact in the middle of those quotes, a market maker knows, oh, here's an actual customer who's coming in, who's not trying to do 10,000 contracts. They're trying to do 20 contracts. It's a retail customer. Let me interact with them and I can fill them at a reasonable price, because ultimately that's what they're to do. If they don't fill orders, they're not going to make any money, because if they're just quoting bid-ask quotes all day long and not getting any trades, they're doing that effectively for no potential revenue, and that's not what they're here to do. So hopefully that gives you some insights into how market making works. And sometimes it's important to understand how the other side works in order to better understand how you can maximize your trading in the markets. So with that, thank you so much for your time here this afternoon. I hope that this was helpful in giving you a better understanding of my views of the market, how I'm positioning for it, and some of the trade structures that you can use for this current market condition. So with that, thank you so much. We will be sharing you both the slides and the recording with as soon as we possibly can after the session. So please look out if you want to review this at any point, or if you want to send it to someone else who you think might benefit from it, please go ahead and do so once we send you that recording. Thank you so much and have a great evening.